is there, I'd heard that if you do this and it's like kind of like doing a HELOC where you are risking your home more than a traditional loan. Is that true?
No, it's actually the opposite. So let me explain why. So instead of just telling you what the answer is and you wondering why, let me explain why. There's a couple of reasons. One, when you do a HELOC, you're at no more risk. And in fact, I've got some things that you can actually research where I can show you why you're at less risk than you are with a mortgage. But one, obviously it sounds like you've already done the math and you realize that you can pay it off faster, right? So do you think you're at more risk by having a lower balance or a higher balance? Well, that's rhetorical. Obviously, you're going to have a lower risk being at a lower balance than you would at a higher balance.
Right.
Another thing that people are unaware of, do you currently have a mortgage?
Yes.
How long ago did you get it?
Actually, we just refinanced 3 years ago, so that's 27 years left.
Perfect.
Well, I mean, 27 years if I was paying the minimum.
Yep.
We don't pay
So in those disclosures, if you don't have a copy readily available, not meaning on this call, but just somewhere, probably in storage if you're a lot like me, you can always call your title company that closed you and get a copy of it. Specifically, what you're going to be looking for is a document that you sign called the Mortgage Acceleration Clause. There's going to be 9 different ways from Sunday illustrated on that clause of they have ownership rights to your home for almost any reason at almost any time. Now, been in banking and lending for a long time. I've only had this happen once. It is rare, but this is the scenario in which it happened, not to me personally, but to one of my clients. His name was Brian. Brian purchased a house utilizing an FHA loan. And this was, I may get the date wrong, 2010, 2011 timeframe. Actually, incorrect. Yeah, 2011, 2012. And FHA had a guideline change that if somebody, because flipping was a big business back then, somebody would buy a house for 100 grand, 90 days later, they'd sell it for 200 grand. They put a little bit of work in it and sell it for 200 grand. So FHA came out with a new guideline that if the home had appreciated over 100% inside of 90 days, then a second appraisal had to be done. And we were in the middle of the underwriting process when FHA rolled this out, and we didn't get the second appraisal done. So we close, fund, Brian's happy, and I get a call from compliance and said, hey, we've got to refinance this one because we can't sell it off to FHA because they won't take the case number because we don't have 2 appraisals. And it's not as simple as us just getting a second appraisal and saying, here, update the file. We have to refinance it to get an all new case number. I was like, great. They're like, well, here, we got good news. Just tell Brian we're going to lower his rate. So I'm getting the numbers wrong because it was so long ago, but let's just say instead of 4%, offer him 3.75. I'm like, okay, that's good news. I was like, what about closing costs? We're going to eat all the closing costs because this is currently sitting on the bank's balance sheet and we don't want it on our balance sheet. We got to get it off to FHA. We'll take care of the closing costs. All right, so no closing costs, lower rate. Tell him he'll get $1,000 of cash as well for his troubles and 2 months no payments, which everybody gets that automatically when you refinance as long as you refinance on the right day.
Right.
So I call Brian. It's like, Brian, good news, bank error, pass go, collect $200, right? You're going to get $1,000 in cash. We're going to defer your payments for 2 months. The closing costs we're eating on our end, so it's not going to drive up your balance, and your rate's going to be lower, which means your payment is going to be lower. Brian did not accept it. He's like, I do not want to go through that process again. I was like, I get it. It's never fun, even if it's in your favor. But Brian, this is a windfall. You're not going to get this anywhere else. This is free money.
Right.
He's like, no, I do not want to do it. So corporate attorney called me up and said, I was senior vice president at the time, and he called me up and he said, no problem. We'll just show him the mortgage acceleration clause that he signed. He's either got to pack in 90 days or he's got to refinance anyways.
Wow.
Yep. So that's the mortgage acceleration clause. In the HELOC world, it's called freezing. Freezing, there are 2 different scenarios in which a bank can freeze your home equity line of credit. And now freezing has different forms, but there's 2 scenarios by and large that they can freeze your line of credit. One, massive value reduction. And in the disclosures, it will detail out what they consider a large value reduction. Typically, it's 50%. So let's say you've got a home worth $400,000, then it would have to plummet to $200,000 in order to signal the freeze. In this real estate market, that's you're basically going to have Al Qaeda set up camp in your backyard. So unlikely, but it did happen. The reason why it's in disclosures, you look at 2008. There are pockets like Atlanta. I remember I was a big lender in Georgia. We were a national lender, but we did a lot in Georgia, especially right after 2008, or tried to. And if you were within I'd say 100-mile radius of Atlanta, the homes were not going to appraise. There was some neighborhoods that had 90% foreclosure rates. So if it forecloses at this price, it sets the new standard. Then another one forecloses, new standard. People thinking their home's worth $300,000, it was appraising for $125,000. So we pulled out of Georgia altogether just because it just didn't make sense for the bank to lend in Georgia. That's the main reason that form is in there. Or not that form, but that verbiage on that form is in there because it has happened in the past. Unlikely to happen in the future, at least in the near future, I should say. Nobody can predict, the 10 years out, or let alone 5 years out. So that's number one. Number two is you stop paying them, which is really hard to do, especially when you look at our strategy. You're utilizing the HELOC like it's your savings account, it's your checking account. Well, if you're depositing money in there, you're always paying them. The other reason why it's hard to do is...
Actually, let me ask you on that one.
Yeah.
Just because I believe I got that, but so when your deposit goes in, that goes directly to your balance, right?
Yes, minus the interest.
Payment just when you got paid from work.
Yeah, minus the interest of that day. And keep in mind, HELOCs charge interest differently than mortgages do too. It's simple interest, and it's also based on per diem. That day's balance will dictate that day's interest charges. So if the balance goes down the next day, guess what also goes down the next day? Your interest charges. That doesn't happen in a mortgage. A mortgage is an amortization schedule. It's kind of set in stone. That's why they call it a death pledge, because it's a death contract. So that's freezing. Now, freezing has various forms too. Let's say you got a house worth $500,000, you owe $300,000, and your limit was $400,000. Well, they could say, we're going to freeze it down to $350,000, which is above and beyond what you owe, but not up to what your previous limit was. They can freeze it to $300,000, which means, okay, that's what I owe, but as long as I didn't have a need for that capital right now, it doesn't really impact me. Or they could freeze it down below what you owe. Let's say $275,000. Okay, well now you need to rectify $25,000. That's freezing. In my, not my opinion, it's just a fact. I would rather be in the freezing world than foreclosure world. Because in foreclosure, you stop paying a lender for 120 days. It's time to move. It's time to pack, right? It's really hard to miss a payment on a HELOC because think about it this way. This happened, we were obviously in business during COVID. Been in business since 2014. So in COVID, we probably had a half a dozen clients that were impacted by COVID, whether furloughed, we had one spouse pass away. They had an income event, right? But they had been clients of ours for years. So scenario, let's say they had a limit of $300,000, they owed $150,000. Well, now they have income elimination. You can actually use the HELOC to cannibalize itself. Some banks, so in full disclosure and transparency, I sit on a board of a bank up in Michigan. It's a publicly traded bank. And our HELOC, we mechanize this way, that if somebody doesn't make a payment via their income, we automatically pull it from the line. They're never reported late. They just move on to the next month. Now, it's not ideal because that means the balance goes up a little bit, which means your daily interest charges go up. But it's not a missed payment, doesn't impact your credit, et cetera. Even banks that don't mechanize it that way, here's a simple way to do it yourself. You just say, okay, I'm going to take, because I'm sure John's explained to you that utilizing a HELOC is just like utilizing a checking account. You get A debit, it's
Oh,
not
right.
it's not technically a debit card, it's a credit card, but some bankers will call it a debit card, and that's not true. It's actually a credit card.
Right.
But you got
Oh,
ATM,
okay.
you got ATM access, you can do cash withdrawals, check writing capabilities, online bill pay, everything that a checking account does. There's nothing
That's why
preventing
it's
you.
considered credit because you still have interest once you use it, right?
Right. So
That makes sense.
nothing prevents you digitally from moving money from the HELOC to your checking, from your checking back into the HELOC. Now the bank just recorded that as a payment. You're on time until the next month. You just paid them with their own money. And if you've got 150,000, well, you can last a very long time. It's not ideal
Right.
because you're going backwards. You're
Right.
on a treadmill that you really can't keep up with, but it's better than foreclosure. So those few clients that experienced that during COVID, they're not sitting on the sidelines for 5-10 years. They're sitting on the sidelines for 6 months, maybe a year, and then they get back on their feet. It's a blip in
It's
the
a
radar.
temporary defensive play.
Correct.
Right.
So back to the myth. Yeah, I would much rather have a HELOC than a mortgage. Here's another thing that is fairly new. Actually, this year, it was earlier this year, a documentary came out from an economist, David Webb, pretty popular economist, that did some investigative journalism into the mortgage world. And the documentary is called The Great Taking. I encourage you to watch it. It is The Great Taking. It is very, very true. I've dissected it because some of our members brought it up. I'm like, yeah, let me watch it. So I watched it and then kind of gave my analysis to the group. It's only concerning mortgage-backed securities. Basically, long story short, you got a mortgage. There's a document in there, and it's a part of the Uniform Commercial Code, Article 8 and parts of Article 9, that separates the ownership rights from the borrower to the investor. Not even the lender, because keep in mind, these mortgages are bundled up into what's called a security, a mortgage-backed security. So they'll have different tranches. We got, A paper that's 740 credit scores and above. We've got, A minus that's 720 to 740, and they create securities, and they buy and sell this paper on the secondary market. The people that invest in those securities technically have ownership rights of your home if they ever need to liquidate. HELOCs are not bought and sold on the secondary market. It's a bank balance sheet product. It's what banks use as a loss leader to get customers in the door. So that was actually surprisingly good news.
Right.
So hopefully that gave you a lot of specifics as far as the myth of you're risking your home. You've already risked your home. You've got a mortgage. It's a much greater risk having a mortgage than it is a HELOC.